All right, well, let us get started. We're going to dive in today on kind of a free interactive event workshop here today, how to trade uncertain markets with low risk, high return option strategies, the butterfly and the long condor. So again, thank you so much for being here. I love these kind of Saturday events. Markets are closed. We can kick back and just kind of, not have the noise of the market staring at our screen. And we can talk today about, what we're going to talk about are two really great strategies for any type of market environment, but especially when we get into more high volatility or uncertainty, because it can really keep our risks super defined and give us, great potential returns. Again, thank you for being here. A little background on myself. I've been, actively trading for now over 40 years, and that's kind of got to pinch myself when I think about it. But started back in the mid 80s. Was fortunate to get in with a company called Coastal Corporation out of Houston. They had a big refining company with oil and gas, pretty much integrated refineries around the world. And so they would actually had a training program where they'd take you in and teach you or train you to trade, oil products, crude oil, things like that. So I got accepted into the program. Ended up going down to one of the refineries, Corpus, Texas, for about 3 months, and it was great because they, would just kind of put you in the refinery to see, how the whole process or foundation of oil worked. From bringing the oil in from tankers into the refinery, producing products, all that stuff. So it kind of really made it come, to more clarity as to what we're trying to do. Then it ended up in the operations group with the shipping, learned the charter, scheduling, stuff like that. And then finally ended up in the trading group on the crude side. They sent me out to Singapore for a couple of years, which was, fantastic experience out there, trading products and crude. And then went to work for a company called Transworld Oil. They were a Dutch company, but located out of Bermuda. So ended up with Transworld. At that time, they were the largest oil trading company in the world. It was Transworld, Fibra, Mark Rich. And was very excited about that. Spent 17 years at Transworld, 16 years in Bermuda, which was the headquarters, and ended up running the international trading desk out of Bermuda for 10. But that's where I first started trading options. It was back in 1987, and we started trading options on crude oil, and I've never looked back since. So that's kind of where I kind of had my first experience, and then later on, I really got into all the different option spreads and butterflies and things like that. So that's what we're going to talk about today. And again, thank you so much for being here. If you have any questions, feel free to post them. I'll try to make sure I get to them. Sometimes they scroll off, so I miss them, but make sure you put them back up. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. Now, again, like I said, I've been trading options now for over 30 years. And, what I found that the most valuable kind of go-to strategies that can help literally, any trader or investor more than other types of strategies known, and especially when we're into, really extreme market uncertainty. But the two strategies are the option butterfly and the long condor. So they're great for any environment like we're in now, but also when we get into more volatility or uncertainty, these are really kind of the go-to strategies that I like to really look for. And so it's kind of what I call my trading secret weapon. Now, the reason is the huge advantage is that they have a unique option framework that's kind of designed to take advantage of both your time decay and your volatility. Now, these are your two main option pricing components when we trade options. And they can be then used in any type of market environment, which makes them really great for when we really get into uncertainty. So we're always going to have uncertainty in the markets. And so these are two really strategies that you should know and know how to use. So if you just know when to use them and how to use them, they're going to be a great strategy for your toolbox. Now, because they're structured to require only a small amount of your hard-earned capital, that's what really makes them great. So it really makes a potential for great returns, and these can be very explosive based on your lower capital at risk and when you get a really big move. Now, it's kind of what I call lightning in a bottle. I had my first boss when I went to Coastal. He was get excited when we have a great trade, and he said, "God, this is like lightning in a bottle. If we could only, bottle it and use it every time." So I've always remembered that. Now, when we look at the butterfly and the long condors, they're also very dynamic. So they can be used, for a variety of different reasons, with different goals in mind. So you can learn how to use the butterfly and condor, and you're going to be covered for, offense, for, making your money, and also for defense when you're starting to need to hedge. So it really gives you that protection and reaching your goals of profit, plus protection for your trade risk. So they can also be used no matter what the markets are doing. If we're, in a cycle up or down or sideways cycle, they can be used in any kind of market sideways cycles that we have. Really helps to take the unsettling guesswork out of your trading. So we'll eliminate the kind of the stress of you having to be perfect on a stock's direction or overall market. Really eliminates the time decay expense that you encounter from decaying long options, which I'm sure you're aware of how that can affect your trades. Can be structured for very, very low cost or low capital at risk. And that's what I love about them. The risk is so, reduced when you use these kind of strategies. And they're going to be able to then offer you, returns of 10 to 1 or higher. So I'm going to show you some examples of trades that we did that we had about a 20 to 1 return. So they're just pretty amazing when you look at them and how you can use them, for your trading or even your investing. Now, the butterfly and condors can also be used for hedging when you mess a trade up, and that's going to happen. So they're kind of a really fast, low-cost way to cover your you-know-what when a position starts to go against you. And I've literally found no other hedging strategy that comes close to incorporating either a butterfly or condor defense into your trading. Now, by constructing either a butterfly or long condor around a trade that you have on that's under pressure, such as maybe you did a credit spread or you have a debit spread on, and all of a sudden it starts to go against you. So using the butterfly or condor hedge around that core trade becomes really the best way that I've found to not only neutralize your risk, but it's going to actually lower the cost or lower your risk of your trade. And I had one member, Pam, she said, I wish I'd known how to do this hedging before I lost so much money on doing credit spreads. So if you've done credit spreads, you know exactly what Pam's talking about. You're chipping away with that strategy, collecting income. And it's a good one, it's kind of what we call probability trades because you're selling out of the money, high probability. But occasionally you might get one that goes right through your short strike, and then your profits are, kind of whittled down from all the ones that you're winners, and you have that one loser that messes it up. But one way we can defend that is, another strategy is to incorporate a butterfly on it. Now, when we look at the butterfly, it's a basic strategy that what we can do is we combine spreads, all right? So in this example, if I can get my pointer, my pen to work here. One second here. I'm going to broaden this out. My pointer is not working properly. There we go. All right, so anyway, when we have, the butterflies, so what we can do is, like in this example, this is like a call debit spread, right? So say we're long this call here and we're short a call. So this call we're long at 10.10. This was on like the NASDAQ 100, an example off of that. And then we're short against it, the 10.20 call right here. So you can see it's a $10 wide spread, which is, one option contract's equivalent to 100 shares. So that's a $1,000 wide spread. Now, we're long this and we paid $300 as our cost. Okay, so that's the risk of the trade. So the difference is, between our cost and our risk of 300, this has potential to make $700 if it closes at 10.20 or above at expiration. So it's a really good high, positive risk ratio kind of trade that we call it. Now, if we wanted to reduce this risk even more, we can do it quickly by incorporating this into either, a butterfly or a condor. So with this kind of trade, what we could do is we could add another spread on top of it. We could do maybe a credit spread like this, and we could sell, in this example, the short strike, the call right here at that 10.20, and then buy another call to protect that, so we're not, exposed for a naked short. And then we've just created a butterfly. So in this example, we brought in then $200 credit. All right, so we've just gone from that debit spread potential risk of 300 to now, by converting it to the butterfly, we've reduced our risk to $100. So we've got that call debit spread on that we had. We added the call credit spread here. Now we've got our risk reduced to $100. Now, if we go out here at the, we call this the tent, if we go out at the top of the tent at expiration, this trade would make $900. And that would be on that risk that was reduced to 100. So now we've got a potential to make a 900% return. All right, so huge potential there. That's, you know, a pretty nice return. So that's versus, you know, the original trade, if we did the call debit spread and it worked for us, that was going to be about a 233% return. By doing this, we adjusted the trade, reduced the risk, and we still have potential to make even more than a 230. We can make up to 900% return. So we're basically reducing our risk and risking $1 to make potentially 9. So it's really puts the advantage in your favor as far as that. Now, the other one is kind of what I call the cousin of the butterfly, which is the long condor. So not to be confused with an iron condor, which is totally different. The iron condor is just a mix of 2 credit spreads. This is a mix of a debit spread. You might have calls or puts, you could do either way. And then without, you know, having the butterfly, where we're really tightening that, kind of really having to thread the needle, we can expand out our profit zone by selling a call credit spread or whatever. We could do puts as well further out. And now we've got a bigger zone of profit. All right. So that's the condor. And so we do a lot of condors just in and out, you know, and then we do a lot of butterflies though when we're more specific, targeting a very, very perfect kind of a target type trade setup. But the condor is great if you don't have to be exact on your target, okay? So it captures a bigger, wider range. So these are 2 strategies that we use a lot at Power Cycle Trading, and I just really love the advantages that they give you. Now, the core concept that make these 2 strategies work really comes down to understanding how option pricing works. So when we look at the option pricing or whatever for options, when we look at to narrow it down to the butterfly condor, it comes down to then understanding the option pricing and how time decay or theta, the Greek theta, affects the price of your option. Okay, so let's do kind of a short, quick review of that to make sure that everybody understands time decay and the impact. So when we do look at theta, which is time decay, it tells us that how much your option is going to go down or your price will go down over time. So that's the rate of time decay of your stock or your security, your option of that. Now, at the end of the option expiration cycle or expiration day, your theta or time decay goes to 0. And so with the butterfly condor, that's one Greek or component of the pricing that we can really take advantage of because it goes to 0. And when we're selling or doing butterflies and condors, it's got that sell side component to it, which adds that additional positive theta and also volatility, which goes to 0. So in this example, you can see how kind of go through the math and the simplicity of it. So this was like XYZ trade at $45. And what we're doing is I was just reading one of the questions here. Here's one of my members said, after being your member and paying for, finally, I realize now how to protect the spread. That's really good. Yeah, exactly. So that's just somebody put that in. But yeah, when you look at trading, let me back up. The first thing I look at is the risk of the trade. Okay. I think you get a lot of people, get caught up in how much can I make? How much can I make? Well, what you really need to focus on first is your risk. Okay, define your risk and then look at how much you're going to make or potentially make related or based on the risk of the trade. And then you can see and define if it's got a good risk reward for you to do it. So, no matter what kind of investments you do, you're always evaluating and looking at the risk reward of the trade or the investment, right? If you buy a house or buy property, you look at, well, how much do I put up and what's my risk and what is my potential reward? Well, trading, we always do the same. So always look at that risk first and then what's the potential reward? Then we can back into our risk reward, profit ratios. So in this example, XYZ is trading at 45, and we're looking for just a little tiny move, really basically down to 43. So when I'm doing a butterfly, I'm using the body of the butterfly. What we call the body of the butterfly is kind of the target for the trade. Okay. So in this example, we're looking for the price to move down to 43. So I'm going to use the body as my my base target. So we're going to do in this example, we're going to buy the 44 put, sell the 67. So we're paying $238 for that. So $238. Remember, one option contract is equivalent to 100 shares. So we've got a debit cost there of $238. Then we sold the 43 put, brought in $1.67, sold that again, and then bought below it the 42, paid $1.06. So now we've got this kind of narrow butterfly dollar wide spread. Our cost then is that 238 right here. The 44 put cost, the 106, which is your cost of your 42, and then your credit for selling the 43. So that brought us to a total risk of 10 cents or $10 per option spread or butterfly spread. And then our profit's going to be basically you're taking that middle strike, say 43 less your lower strike, or you can take the upper strike. And you can see it's a dollar wide spread between each strike. Okay, so it's what we call a balanced butterfly with a dollar spread risk or spread of the dollar spread or $100, then less our debit cost, and that's going to give us our potential profit. So 43 less 42 less the cost of the trade, the debit cost there, 10 cents. So potential to make $90, 90 cents, $90 on that butterfly if it goes out at the top of the tent at expiration. But if it doesn't, if it goes out anywhere in between, we're still making a great return based on the capital that we have at risk. So again, here you're risking $1 to make 9. So pretty nice, favorable potential return that you can get from the trade. Now the next thing comes down, well then how do you choose, the best butterfly or condor strategy? And that's a really important question because as you're going to see, there's a lot of different variations, which also make it a great strategy. It gives you a lot of different ways that you can do it with or use it within different market conditions. So again, when we look at this, in my opinion, the major goal for every trader or investor is really to select trades that are going to be based on what's going to give you the most consistent positive returns over time that have low defined risk and and not always just looking for the greatest return. So in trading and especially in option trading, I always talk about kind of chipping away, hit singles and doubles, and then occasionally you're going to hit that big triple or home run, but you want to stay consistent. So we're looking for defined risk trades that have potential to give you the big return as well. And then one of the best ways to achieve this goal is to understand what option strategies that are out there available to you, then look at and understand how they work, and then select the one that's going to be best suited for the environment you're trading in and your specific trading goals. So, everybody here is going to have a different amount of capital trade. Bill might have 100,000 and Sarah might have 10 or 5. So that's going to make a difference in how your trading goals and how you trade. And some people or traders are more aggressive as well, or you may not have as much time. But the one thing that stands out is that the butterfly and condor, you can trade these two strategies, with one contract or thousands. It's a great strategy for the hedge funds, but it's also a great strategy for the small, retail investor like ourselves. All right, so it gives you that flexibility to trade the market. Now, when we look at the butterfly strategies, I kind of call this the butterfly family. So they're all going to have a basic component, which is a selling time and volatility is a big part of the spread. Okay, so that's what really makes it really work and makes it really dynamic, because it gives you potential for bigger profit, and it also gives you what we call positive data. All right, so we're not going to, when we do these two type strategies, if the market's not going where we need it to go, we're not losing on that long option, from time decay. These are always going to be a positive data trade. So if it just sits, we're still making a little money, we're not going to lose money. And then it moves in the direction we need it, we can make a lot of money. So the variations are we can do a long call or put butterfly. We can do what we call a broken wing butterfly using calls or puts. We can do what we call a ninja unbalanced or ratio butterfly. There's the iron butterfly. There's also then what I call, which we're going to look at, the lotto butterfly, which are really cool. And then there's hedging, okay, the defensive strategies that you can use using the butterfly as a defense strategy. And then there's the kind of what I call the cousin, the long condor. And then we can even get more even deviations off this. We could do a broken wing ratio butterfly, or we could do a broken wing, condor. I mean, there's just so many things that we can do, but these are the kind of the main variations of butterflies and the condor itself. All right, now the next thing let's go through the best thing to understand and how to use the butterflies, just see how they work, right? Like kick the tires. You go buy a new car or a house, you want to see what it looks like and kick the tires and see if it's something that makes sense to you. So let's go through some examples so you can see. And the best way to learn how to, trade is to look at your winners and your losers in the different trades and see how they perform. All right, now when we look at a butterfly, we can then use the butterfly wingspan to adjust risk and our profit, okay? So kind of a good analogy is if you're a butterfly collector, maybe somebody here is, I'm not, but if you were collecting butterflies, it's probably a lot easier if you have a really wide net, to capture the butterfly versus, a little small net. Same difference with the butterfly. So if we want to get a bigger profit zone, we can make what we call a really wide wing butterfly, right? Now this gives us this wide zone, and if we get it really perfect, we can make a huge return on our low risk. But if we get anywhere in here, we still get a great return. Now, if we want to really tighten our risk up, though, we can narrow the butterfly, okay, the wingspan, and so we can make it tighter. Now this will reduce the cost of the trade, the risk, but also if it goes out, especially at the top of the tent, the return on that low capital at risk, these things can be huge. I mean, these can be 10 to 1, 15 to 1, 20 to 1. And I'll show you some examples of ones that we've done that illustrate that. Now, here's the first one I wanted to show you. This is a butterfly on SPY. The other thing is also with the butterfly and condor, long condor, they're great for ETFs, index options, great for any kind of stock. You need liquidity like anything else. But we do a lot of these, with the ETFs, SPY, fantastic for butterflies, the Russell, IWM, QQQ, great for butterflies, the Diamond, great for butterflies, SMH, any of the ETFs. We just did a trade Friday on the XLI, and we also set up in the room a butterfly. I'll show you that if we have time. Right, so these are great, or you can do them, with the index options, SPX, NDX, or you can do them with futures contracts. You can do it with ES, you can do it with gold, anything, Apple, whatever. So we'll go through a lot of examples. So this is what you call a narrowing butterfly, where we're keeping that spread width tight and we're keeping our risk super low. All right, so here's an example of that. Now, also in the course, you're going to get this part of the course bonus package here for the course is what I call my price target mapping, which is, how we map out our targets for profit or defense. And it combines Fibonacci, moving average, option activity, etc. But I like to use Fib. So in this example, the SPY was trading at 267. We're looking for an upside move, and I was targeting the 618 retracement. And this is what we call also price action support resistance right in here. So there's a lot of activity there and a lot of option activity there that we could see from the option platform. There was a lot of open interest and a lot of volume going in at this 273 strike. So it's a great profit, our target for a butterfly. So that was going to be our target. So we're going to set that as the target, and then we're going to back in and put a butterfly targeting 273. So in this example, again, I was trading at 267. So we went out and did a 272, up a little bit higher than 267. So 272, 273. See, that's a dollar wide spread, or 100, and then the 273, 274. So we had a very narrowing butterfly. So dollar wide there. Okay, question. Yeah, good question. Question. Could I compare the butterfly to a calendar trade? Absolutely. Yeah, we do a lot of those. Now, so you can see here the spread is $10. Okay, so that's $100 per spread. $10 times 10. 100 shares per option contract. So spread of 100, and our cost here is 10 cents right there. Debit costs are $10. So the difference is if it goes out at that 273, we would make $90, a 900% return. So risking $1 to make 9. Now in this trade, this example, we ended up making $70, but that's a 700% return, right? So when you think about it, you might tell one of your buddies, "Hey, I just made a 700% return." They might think that you're, kind of lying to them. But these things are This is how you do it, right? So in this example, you can see that it went from, here's the top of the tent. Now see that little black area? That's still potential profit from the time value and the volatility from this trade. Now at the end of the expiration series, both time and volatility go to zero. Okay, so we have that additional sell side component where we're bringing in more time and volatility, implied volatility. When you short an option, you're shorting time and volatility. All right, so in this example, it went from 10 cents to 80, okay? So there's your $70 per spread. And this was on like 4 contracts, so this was up 280 bucks, on that risk of $10 per spread or 400 bucks. So that's where your potential return of 700%. So you're getting that big advantage of that time decay collapse, volatility collapse, and a high potential return on your capital with a super low risk trade. So if everything went wrong, you lose 10 bucks, which is, you can handle 10 bucks, but when you're looking at maybe 1,000, huge difference, right? Now, the next thing is what we call the wide wing butterfly. And this is primarily the ones that we will go to because it gives us a bigger profit zone. So it gives us that wider profit zone. Structured for defined risk, great for hedging, used for what I call targeted directional swing trades. So the trade setups we're typically doing are what we call swing trades, which are based on a daily time frame, and these trades could last from, could be 1 day to maybe up to, 1 or 2 weeks. So these are great for what we call pinning trades, where you think, the price of your security may go out at a certain strike price at expiration. So that's what we call a pin. Really great for, again, high volatility markets because we can reduce that risk. Plus, remember, when implied volatility increases, the premiums of your option go up. And so with this, it increases the premium price that we bring in from the sell side component. Really great if you want to trade high price stocks, which will show you an example of that. When you get stocks that are over $1,000 per share, that puts a lot of people out of the game, right? But we can use a butterfly and you can stay in the game. Duration on these things typically could be either 1 day, short, or out to 2 weeks. No time decay. Positive data returns 10 to 1 or higher, or much higher than 10, which I'll show you here in a few minutes. So these are just so dynamic. All right, so here's an example of a short trade on QQQ. And this was a wide wing put butterfly with the spread width of $1,000 on the spread, okay? So in this example, we were shorting the market and it was trading at 314.60 right here. So it's trading right here, 314.60. And then we took this short trade, no, I'm sorry, right here, backing up, right here. Okay, it was trading right there. So, my model that we use, and these are available if you want to include this, if you do sign up. You can use my trading indicators here. You can buy these for $195. You can see that upsell when you check out. But these are based on momentum. So I use cycle 1 as a fast momentum indicator, and 2 is a slower confirming indicator in a cycle reversal. So momentum was down. We took the trade and we were targeting down to like a 304, right down in this area here. It's kind of a 50% retracement. And that was a 50 simple moving average. So it gave us a good target to trade to. So this was going to be targeting 304 and it was trading at 314.60. So $10 higher basically, right? So the trade setup was to target that 304. So we set that up, and that was our body of the trade. So we did the 314 put long, short the 304, short the 304, buy the 294. So balanced butterfly, $10 between each strike. Okay, so $10 or $1,000 wide. Cost of this trade was $2.10 debit cost. Okay, for the trade going in. So that's $210. So the difference would be, if it went out right at our top of our tent at expiration, we would make $790 on that risk of 210. That'd be a 376% return, or risking $1 to make $3.76. Now, if you did just the ETF, and just did that without the options or whatever you're shorting, in this example, just kind of compare it, you would have made from 314.60 to 304, you would have been up $10.60 per share, and that would be a 3.36% return. So look at the difference, huge difference as far as your potential return plus potential risk when you have to buy shares outright or something like that, or short. All right, so here's what it looked like, going out. It was going out right here. That teal is where it is at expiration. So you can see it was going out at 306.17. So not the perfect pin, not perfect at 304, but big, nice enough. See how wide that is? So anywhere in here would be a profit. So it was going out right there. So this went from $2.10 or $210. Now it was up to $782. So this was up $572 per spread. Okay, if you did one spread, 572, you can do the math. If you did 10 or 5 or 1,000, I mean, I've seen thousands of these things done on crude, butterflies, things like that. So that's a 272% return versus, if the shares would have been a 3.6% gain. So again, just so dynamic, and it's going to take advantage of your time decay, volatility decay or collapse, low defined, high return kind of trade. Now, this is a really great example to illustrate how you can use the butterfly to trade high price stocks with super low risk using the wide wing butterfly. So this is an example back on Amazon when it was, trading well over $1,000 for a long time until they split it. But this really illustrates how dynamic the butterfly can be for your portfolio. So in this example, it was trading at 1,782. So remember, one option contract is equivalent to 100 shares. So if we were to do the equivalent of, buying Amazon and we bought 100 shares, you're putting out $178,200, right? Well, that's a lot of capital. That's a lot of risk potentially. If it goes down, man, you've got a lot of potential risk. All right, so we were looking though for a target up here to this 1830 and been trading right here, chopping around on this support. That's a 200-day moving average. And we were looking for the next target up was this 1830, which seems to see it hit here, hit. So a lot of hits there. So we were targeting that area. All right, so we did this trade instead of just buying 100 shares outright and paying a lot of money, over 178,000. We did the same kind of controlled risk trade, more controlled risk. In this trade, the way we set it up cost $80. Okay, so here was the trade. So we were looking for that target to 1830. It was trading at 1,782. Now, if we bought 100 shares here, we paid 178,200. And we hit our target at 1830, we would be up $48 a share, 2.69% return. Well, that is not too great, if you look at the risk. But for the same type of trade potential, we were able to do this with the butterfly, which cost 80 cents or $80 per spread versus 178,000. Okay, so this was buying, and we were targeting that 1830. So we went out and we bought the 1820 call. Sold the 1830, sold the 1830, bought the 1840. So $10 wide spread, 1830 target. Now this has then potential to make that spread width, 18, 20, 30. You can see it's $1,000 wide, less the cost of the trade, potential to make $920 on that risk of 80, 1,150% return risk $1 to make 11.50 versus making 2.69. So tremendous type of trade that you can do. Okay, so here's just your risk profile. You can see right here, potential to make 920, risk of $80, and there you go, bingo on that. But if you don't get that perfect pin, you still make a ton of money, or especially return on your capital. So here's the other thing I wanted to point out, though. This is what makes them so dynamic. You can see all that black area in there. That's what's left. This is the same day. This is on the expiration day of the 6th in the morning, about 10 a.m. So at 10 a.m., it was trading somewhere around 1836.50. Okay, but you can see all that potential profit is still in there from the time component that you've sold in the volatility. But it was trading right here. Okay, that purple is where it is in time. But it was still up a nice return on the risk. So at this point, it was up at $230 per spread on the risk of 80. So this was up $150 per spread. All right, and that would be a return of 187%. That's still not bad, right? I still take that all day long. 150 bucks potential, and your return then is 187% return on your capital. But here's where the same trade, Amazon, but on the same day, but later in the day, look what the difference is. So this is, towards the end of the day, getting close to the day of that, getting close to the time for the market to close and expiration. Now look what happened to the spread. You can see the tint here. There, look at the black. This went earlier, it was down here. Now it's sucking all the time, the profit and the volatility profit. It's going straight in your pocket from the time decay going into the expiration on that day. All right, so here later in the day, this thing now has gone from 80 cents or $80. Now it's up to $695. Okay, so that is then a profit of $614 per spread. So it's gone from $150 per spread in the morning, which was 187% return. Now in the afternoon, this is 4 times more, and now it's up to 614 per spread, 769% return versus earlier in the morning 187. And if you did the stock, you were up 2.69% return, plus had that huge risk. All right, so that's the beauty of it. So at the end of the day, it goes to zero, and you're sucking out all that additional time and volatility from the short side component of the spread. So great way to trade high volatility, high price stocks, plus the dynamics of that additional spread, credit spread to it, sucking out time and volatility. Now this is one we do a lot of, and this is what we call the long call condor. So you can do condors with puts or calls, just directionally, making sure whatever direction you want to target. So this is one that we just did recently on Apple. These are all alert trades that were sent out to the alert members, okay, over various periods of time. But this is one that we just did about a week ago. This was on Apple, okay. So this is one we set up for a long trade on Apple. This was one we set up, again, alert trade sent out to the members on the 21st of November. And Apple at that point it was traded at 228.80, all right. So it was trading right here, okay. So this is coming into this 50% retracement level, fib line that we were looking at. You can see it was kind of chopping up here. We had positive momentum, all the things that we look for. We were looking for a potential break higher, but we were going to cap our trade risk up here at these highs. So it was a perfect place to set up a long condor. So we're going to, have a breakout move, but we're also going to bring in some good credit by capping the trade up at this top end at these prior highs for this expiration duration that we're going to do. All right, so we're able to keep our risk super low, but have potential for really nice return and a positive theta. So we went out, it was traded at 228.80. So we did a 29 November expiration. So basically we're long the 230 call, short the 232.5 call debit spread. Okay, and then we added to that a credit spread, short the 237.5, 240 call credit spread, okay, to cap the upside, bring in more premium, reduce our capital at risk, and give us a greater positive theta. All right, so we ended up with this kind of structure here. And we reduced our risk down to $82 per spread. So The total risk was 82 cents or $82. You can leg in, leg out, or do it all at once. Potential profit, $2.50 wide spread, $2.50, less our cost of the trade. Potential to make $168 per spread, a 204% return. So these are what I also call low stress types of trades. You know, you've got low capital at risk, but potential for high reward. So this was perfect. It went out exactly where we wanted between these two spreads right there. And so this went from, you know, going into expiration, it was traded at 235.74, bingo right there. So it went from 82, our cost, to 249. So we're up $167 per spread, or a 203% return. All right, so that was a really beautiful trade setup there. So that was a long call condor. All right. Now, these are really fun. These are what we call our lotto ticket. So this is the butterfly. This is where you can really, you know, make you know, those home runs. You know, you're chipping away. And so this is from one of my members, Bill, and he really summed it up perfect. He said, the butterfly strategy is one of my favorites. It's the big winners that eventually make the difference in any trading account, right? So you're chipping away, and then you make that big one. Your equity curve goes up. You're all excited. So he says, with all the low risk option strategies being sold to the public, an account without the potential to hit that big one once in a while not betting the farm is kind of a slow ride up a long hill, right? But this strategy is easy as ABC, and so it really is. And so it's such a good summary. Now, this was a butterfly penny trade alert that we sent out. This was on Tesla, which can be a really great vehicle to trade for butterflies. And this one we did back, this was back in February. This was an unbelievable trade. I love this one. So we set this up on the 8th of February. Tesla was traded at 189.35. And we had a target for potential. We were looking for a pin at 200, okay? So we set this up actually 2 weeks out. So expiration was on the 16th. So this was the spread. Then we ended up with the spread profit of $231. This was up 1,925% return in 8 days. Okay, so here it was. This was Telegram. This is what it was sent out. It says, when I sent it out, I said, new Tesla long binary monthly butterfly option pinning setup. So at that point, Tesla was traded at 189.35, and it says trade set for potential monthly expiration pin at $200 next Friday, 16th of February. So sent this out to the members. So buy one, you can buy 1 or 10 or 1,000, whatever. Buy one butterfly Tesla, the 16th Feb, 197.5, 200, 202.5 butterfly. Okay, right there at around 12 cents, which would be $12 debit paid, and that's your risk. There will be no adjustments or stops. This is binary. So we either make it or we don't, or you can, you know, you can do whatever you want. Now on the 16th, here it was trading at the option pinning trade. It was trading at this on the 16th. It was trading at $200. I sent this out to the members. Butterfly going out up $215 per spread, or a 1,791% return. Take profit here, make sure to close trade out prior to today's close. And then here was just a little bit later towards the end of the day, right? This was at like 252. This was coming in right at the end of the day. And I sent out, I was just amazed at how perfect this was. I said, wow, it was a perfect pin. Tesla long binary butterfly penny trade at 200, up $230 per spread, 1,916% return. Okay, so that is how you can see these things are possible, right? So we set the trade up here, and it was a trade setting up for your target here based on Fibonacci, moving out, a lot of stuff that goes into it. And in the course you get as a bonus, it'll teach you how to do your targets. All right, so set that up targeting 200, and that's where we got it. We got it right to 200, and here's your risk profile. You can see this was doing the 197.5, 200, 200, 202.5. When we set it up, it was traded at 189.35. So we set this trade up 12 cents, or that's $12 per contract. So spread width to $150 wide. So potential is for $238 return on that risk of 12, 1,983% return. And we made very close to that because it did pin right there. Now, when we do these trades, we don't keep the whole thing for that last day. We'll be scaling out because, you know, it could go back and forth. But what you want to do is save some dry powder to see if we can get that perfect pin. So you're just kind of scaling out. Now, and I send out alerts saying, okay, you might take some profit here, save it, you know, blah, 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 to kind of guide you as you go. So here's where exactly it went out, right there at the top of the tent. So you can see here it went from 189, now it's trading at 200 right there. So this went from 12 cents or $12 to $2.50, max profit, $238 per spread, 1,983% return. All right, so that was pretty cool, pretty exciting actually on that one. And here's another one we did not too long ago. This was on GLD. GLD is also a great one for butterflies and condors. And this is one that we did. This was on the 8th of August. So these are very selective, you know, but this is another one that we did. And GLD was traded at 222.85 when we did this. Oh yeah, Charlene, hold on. Somebody wants that link again. Make sure that you have it. Here's the link if you want to join in for the course next Saturday. Use this link here. Okay, and then that go, yeah, okay, and then use small cap BF15, and you'll get that discount of 15% off either course package 1 or 2 if you want to do that. So here's the other one that we did. So here it is, the 8th of August, said new long GLD binary call butterfly. Okay, it was traded at 222.85. So we originally set this up, we were targeting 225 and then adjusted this up to 230 because we saw a lot of activity. Anyway, that's where we ended up. But we originally set this up targeting 225 and we were into this trade. I said, get into it around 24 cents. All right, then the next day we adjusted this up targeting the 230 right here. So I said, this is what the adjustments look like. They're very detailed. And so we adjusted this to a 227, 230, 233 butterfly. And we had a risk, I think, of about $27. So, and then here it is on the 16th, which is your expiration day. A couple alerts sent out. It says trading around 229.88 and trending towards the body of the butterfly at 230. If long, this butterfly, look to take some profit today before the close. The closer to 230 into today's close, the greater the profit. The potential max profit is around 270 per spread or 900% return. Currently up $150 per spread or 517% return. All right, so then here it went out towards the end of the day. I said currently up around $200 per spread or 689% return. Okay, so constantly updating you on that trade. So here it was when we set it up, was right here. And we originally were targeting 225, but we saw some bigger potential at 230, so we adjusted it up. And we ended up pretty much hitting it very, very close to that 230 strike. All right, so here's what the options look like here. You know, when we set it up 222.85, so we bought the 227, 230, sold that. 230, bought the 233, had this butterfly on. Spread width at $300. Our cost of the trade was 89 cents or 89 bucks. Potential to make 271 or a 934% return, or anywhere in between there is still a great trade. So with this one, we ended up, scaling out, but at the end of the day, we're right here taking profit right there, boom, at 230.47. Right, still pretty good. Not quite a perfect pin, but this went from $29 to $232, which was a $203 per spread profit or a 700% return on that trade. So those are really cool trades, and those were, again, trades that we sent out. Now, this next thing is what I call hedge trading management. So this is where you can, use these kind of spreads to, convert trades, your core trades into butterfly or condor to reduce your risk. And what we try to do is a lot of times, sometimes we're able to convert the whole trade to a free trade where we have no risk at all. So in this example, this was a QQQ short that we were able to adjust to a long put condor that then had no risk. It was a free trade, okay? So just kind of want to show you how you can do this. So here was the trade setup going in. It was trading right here at 365. We were shorting. And so it's trading right there. And so it started breaking down. Indicators were all giving us an indication for a lower move. And so we're targeting down to this area down in here based on Fibonacci, other things that we're looking at. So we did that trade setup. And then on the 1st of October, we were able to adjust it to a free trade because we had it moved so hard down. See right here? It moved so hard down. When it got down here, we had so much profit in the long put part of the spread. We were able to, take that profit, adjust down the trade, and we sold it out of the money bull put credit spread here and brought in a huge amount of premium, which offset our debit cost of the original trade. That's kind of basically how it works. So then at expiration, we had max profit, and it closed at 359 right here. So anyway, perfect trade setup. And these are what we're looking for. Always talk about with the members, look 2 to 3 steps ahead to plan out your trades. And this is one that we planned out. So here was going in. You can kind of see it trade. I call it trade 1 was the original trade setup. Long the 364, 360 put debit spread. Cost of that was $121 per spread. So nice risk reward actually on this trade. Okay, so we're long that put here, short the put, nice wide spread with their $4 wide. So potential to make $279 per spread or 230% return, not bad. But when we had this big move, the market collapsed, and we were able to add another spread to it, which brought in credit to offset the debit cost. So this is basically what it looked like. So trade 2 then, on the 1st, now the market had collapsed and was trading at 354.53. So we set up a bull put credit spread. We sold at 354, 350 credit spread. Brought in, see here, we brought in $141. All right, so our initial trade, we had a debit cost of 161. When it collapsed down, we sold the credit spread, brought in 141. So now we have this long put condor in zero risk, right? We actually had a $20 credit, 141 less 121, $20. So we ended up with this structure here: long a put, short a put, short a put, long a put, and we had a zero risk trade. Okay, so we could just sit back and let the market do what it wanted to do. If it goes out in here, we make 420. If it goes out anywhere here, we make profit. If it goes straight up, straight down, we still make $20. So just a really cool trade to use. So this trade actually ended up making $420 on that zero risk. Okay, so those are really exciting trades to do. And here's your risk profile: 420 on a $20 credit was what it ended up with. So they're fantastic trades, that strategies you can use. They're a lot of fun, and they have so much potential and flexibility. Now here's one I thought I'd show you, just a quick example. One second here. This is one that we actually, this is one that we actually set this one up in the room last week. Let me show you. If you were in our trading room, you would have, we went over this if you wanted to do it. This was on the 12th, and this is when we actually did that short trade that I showed you earlier. I'll show you that again. But here, there's a lot of activity at that 230 strike. This is a really potentially great place for a pin. You can see that 50 simple moving average coming in there. There's a lot of other stuff that we're looking at. But if you had wanted to do this, this is the trade that we went through, and this was doing a butterfly targeting that 230. And at that time, when it was set up, here's where it was. It was trading, when we set that up on the 12th, we ended up the 20 December, 234, 230, $4 wide, 230, 226. So it's a balanced butterfly. It was at $75. Okay, so That's your total risk. Now, if you get a move and a pin next Friday at that target of 230, this would be up 325, yeah, 300, no, 200, let's see here, yeah, $325 is the potential max profit if it goes up perfectly right there. This would be $325, and your risk was 75, right? So that gives you potential 433% return. All right, now if it goes out anywhere in between here, though, you still make a nice profit. So let's say it goes out, maybe next week at here, this teal line is what it would be at expiration. So if it was trading right here, we'll say 232, this will be up about $105. If it's trading at 231, this will be up about 211. That's on Friday's expiration, but we can also see what it's going to do at any point in time during the week based on our analytics. So these are things that I'll be teaching in the course. And so just kind of wanted to show you, one more example there, so you can get a better, clear idea on, how these work. So if you'd like to join us then for, learn how to do these high reward, low risk strategies that again work in any environment, here's what I've got set up for you. And this will be next Friday. It'll be live and recorded. And then here's everything you're going to get. We'll go through this in greater detail. So here's an easy way to follow along. Just put in that link that I gave you, powercycletrading.com/special, and you'll get the this link, and you'll get the discount if you use that promo code smallcap BF15. So this is the course. The price was $197, but if you sign up today, you're going to get that discount of 15% off. So it's $167. And then additional Christmas bonus, you're going to get 2 months to my trading club as an additional bonus. So these are 2 additional free months. So what you're going to get here is you'll get the live course, $1,600. Course, when we send out to everybody else during this next week coming up, it'll be $197. But today, if you use that promo code BF15, you're going to get the course for $167. Now, included, if you want these bonuses, they come with the course. You'll get my Fibonacci price target mapping course, which is super important for mapping out your targets. So if you go to my website, that would cost you $297 if you didn't want to buy it there. You're going to also get my Start Trading Options Today, another option course here. That's $197, and then you're going to get 60 days to my membership, which is, if you stay on, it's $97 a month. Per month is the actual price, okay? But you're going to get 2 free months there. Then we'll do a follow-up Q&A support, live and recorded. You also get my option trading tutorial based on gamma, delta, theta, stuff like that, and my 15 option strategy guide. So a lot of really great additional stuff you'll get with the course. The full values over $2,700, and today it's $167. So you're getting pretty much 94% off of that value. You'll get everything recorded, broken down in 30-minute modules or less. The training manual, the full course, PowerPoint, handouts, follow-up Q&A, all that good stuff. Now, if you want course package 2, this would include my 5 different alerts that I send out. You're going to get my alert service for 4 months. You'll get my alerts for the next 4 months, but I'm giving you 1 extra month to the trading club. So you get the alerts for 4 months and the trading club for 5 months, which we'll go through. That gives you access to the trading room, Q&As, all that good stuff. And if you've been looking for more help and guidance to help you select trades, a big hard part of trading, probably, as you know, is finding the good trades, right? And so I spend a lot of time, scanning and doing special scans for the trades that I send out. I'm very selective. So with this course, this package here, you get my 5 different alert services. So I may see something I send out. It could be a butterfly or long condor that's perfect for the current environment, or it might be that we want to do a calendar or calendar diagonal, or maybe it's the butterfly penning trade, okay, or maybe it's a breakout reversal. So on Thursday we did a breakout trade on IWM. On Monday we did a call calendar diagonal on XLV. Okay, so it just depends on what we're seeing. So we did that one on Monday, we did this one on Thursday, et cetera. It could be an earnings trade, or it could be a butterfly, which we did in the room on that IWM, you know, on Thursday as well. So these are the different ones that could be sent out. Okay, what you get, and then when I do send it out, you're going to get also with this package, you get everything that you know, the live course, all the bonuses that you saw in package one. But this whole value, you know, after today is $597. But if you do it today with that promo code, it's $507. There's also 2Pay if you want. So you get all 5 of my alert service, that whatever sent out for the next 4 months. So typically, you know, shoot for 8 to 12 either stocks or ETFs, you know, per month. Could be more at some points. And these would be either, you know, selective butterfly or condors, or calendar counter diagonals, or the monthly, you know, butterfly pinning type trade setups, or breakout reversals. These are usually just long call or call put debit spreads or credit spreads, and selective earning type trades. All right, so when I do send these out, we use Telegram. I'll send out a very detailed guide for each trade. I constantly update, you know, with the alerts, if you know, to tell you what's going on with it. These then are set up. I do a video review of every trade that I send out during the day, you know, that afternoon or evening. All the trades are, you know, listed in archive. Then we do a Q&A every week that's live and recorded, so you'll have access with your membership for this for the next 5 months. I do a daily video newsletter. You'll have access for that for next 5 months. But here's a big bonus: is I have a virtual trading room. Okay, so you'll have access to the virtual trading room every day during the week for the next 5 months. And anything on my website you can get at a 60% discount with you'll get a members promo code that will give you that, and you'll have access for that for the next 5 months. So just a really good all-inclusive package there. And here's just kind of a summary again, just to kind of take you through it. You know, I started the first part of the alert service, you know, I think it was the breakout reversals and credit spreads back in May of 2018. Then I've added different ones to it as we went, you know. So with this though, through yesterday, we've had 810 trades closed, 583 winners out of that, 53 break-evens, 174 losers. We're winning percentage around 79%. Now, again, these are unaudited. The summary of those trades that we've done over, you know, those years, kind of just keeping it updated. And again, here's your link here. Use that special link and that promo code, and you'll get that special discount here today. All right, so we can go through that here. Yeah, here it is, Charlie. Just click on that, and again, it'll pull up this payment drop-down link you can use, and just come down here. You can see whatever package you want. Again, you get that 15% off if you use right there BF15. BF15, okay? You'll get that discount today. And so then come down here, you can see what you're getting, and you know, click the buy now right there. And then if you do, yeah, if you want the indicators, John, just come down here and you see here, this will give you my indicators. These are available for Thinkorswim, TradeStation, eSignal, TradingView. So just click on that, add that if you want to add those to it, and then put the promo code in, BF15, and you'll get the 15% off on that full value there. Or if you just wanted, you know, the course, et cetera, you could do that. See that 167 and the indicators, okay? So that's that. Now, if you want course package 2 with all the alerts, then you're going to get that alerts for 4 months, the trading club for 5. Come down here, you can see everything that's, you know, pretty much in there, kind of summarizes it for you. The trading room's open every day during the week, 9:30 to 10:30 a.m. Eastern. Now you can come in and ask me questions on trades that you have that you might want help with, or a trade you're looking at, you want my opinion, or see what we're doing in the trade room as far as new trade setups. And so if you want this, then come down here and put in the click there. So it's $597. There is a 2Pay if you want that. You can see here you can have 2Pay. And you'll also add the indicators if you want. Now to get the discount, again, just put in DF15 right there, and then you get that. All right, so that's all there for you. Makes it pretty easy and smooth. And again, if you want to check out, make sure that maybe you have it or in the past, just go to your account and you'll see if you don't see that, then you don't have it. Now the other thing too, some people question, well, what if I already have maybe the Fibonacci price mapping course or start trading option? Well, these are just bonuses, okay? So these are just free additional bonuses that I give out because they're important for the course so you can understand, the course that I'm actually doing. These will help you in the course, the price target mapping, the option, start trading options if you're not as up to date on options. So to really kind of help you smooth things out. So those are just additional bonuses there, but the course package with all this, again, is $167 today. All right, now here's what we're going to cover in the course. It's a very extensive, detailed course, a master's course, basically, just specifically on the butterfly and long condor. So we start out with the course. Just I want to go through the Greeks that are vital, that so you can understand how these two trades or strategies work based on the option Greeks. And I'll have simple explanation of how the Greeks are used, not real detailed complication on the Greeks, but it's important that you kind of understand then how does theta or time decay impact these two strategies, and how does volatility impact them as well. So we'll go through that, starting with the course, volatility crush, things like that are important that you understand for the course. Hey there, Matthew. Missed some of the questions earlier. Here's one that let me back up and read. Yeah, you can do that. You can view that will be recorded. So here's a question. I got to run, but I'll see you next week. Thank you. A question for next week. Better determine where the price will pin. Can we see? Yeah. So the question is, he wants to understand how you do the pins, how you select the places for a potential pin, and that's what we're gonna. A big part of the course is how that is done. All right. All right, so then we go through pricing the option, how that works. And this is a big part, again, using what I call Fibonacci price target mapping and standard deviation analysis to help us select our targets. All right, so this is, in this course, we'll go through this, but you also have this much greater detail 3-hour course as a bonus for that. So you're getting a lot of additional good stuff here. And then part 2, we're going to dive into these different variations. So in part 2, I'll go through every variation, how, why, and when then to use. So you can see how they're done and how they're used and when to use them. And then you can determine, okay, well, maybe I should do a wide wing for this or a broken wing. So I'll go through every variation of just a regular call or put butterfly, the variation of a wide wing butterfly, how the broken wing butterfly is used, what is and how is a ratio butterfly used, a broken wing ratio butterfly, what that is, how it's used, iron butterfly, those lotto butterflies, vacation, and long condor. So very detailed, everything's butterfly and condors. Yeah, so if you stay on for another 4 months or whatever, it would just be the additional, it would add up to. So question is, if you stayed on for another 4 months, what I typically do is so the course value is $597. If you look at that, and the price, if you don't take the alerts, is $197, right? So for 4 months, the 4 months to the alert service is basically $400, okay? So if you do want to renew then for another 4 months, then it's going to be, so far I've just left it alone. I haven't increased the price. So it's just would be $400. Okay. So that's what it is. And if you look at that, if you break that down, that's, what is that, $100 a month? And, you're looking at $3.33 a day, but today you get a discount. So you're looking at about $3 a day, to add those. So, I mean, the alert service is a great thing to have because you're not looking out for the trades. And my winning percentage is, I'm really selective, like I said. So I'm picking the trades, and then you don't have to take the trade, obviously, or you may want to do it different. So, but I just give you a lot of members they just want the trades that do their own thing. And then we go through what are the best time frames to use. So, a lot of sometimes confusion. Should I do this, 2, 3 weeks out, 4 weeks, whatever. So I'll go through the time frames to use, the best stocks, ETFs, index options, and then how do you actually, profit from that volatility collapse or theta decay. So you'll understand how that works by the end of the course, and then how that we can get these 10-to-1 or higher type returns. And then the really kind of another fun part of the course actually. Yeah, okay, so good question. Can I vary the date of the start of the alerts? Yeah, great question. So if you want to, on either, so if on either package 1, you can start your trading club at any time. So you're gonna get, if you do course package 1, you're gonna get 60 days. That's kind of additional bonus. But you can start anytime you want. You don't have to start until after the course. You don't have to start, tomorrow. You can start a week, 2 weeks, whatever, but you'll get 60 days. Now, with the alert service, you're going to get it for 4 months, right? So you can start it whenever you want. But if you, let's say you have to go on vacation or business someplace for a week, 2 weeks, 3 weeks, you can stop your service and start it and stop it. So you're not going to lose and use your time. All right. So you're not, once you're in it, you've got 4 months. If you want to stop it, you can stop it, and you're not going to be, it's not going to, the time's not going to go against you until you start it back again. All right. So try to make it super fair that way. Now, then the other part of the course, these are so much fun, and these are the ones that can really get exciting. These are, we'll go through how to do these penny butterfly trades, and then how we go about selecting, the butterflies for the pins, how to set them up, the analysis used there, okay? And so these are basically, monthly. We usually use it on monthly, so 12 times a year potential. And these are the ones we call pinning. So these are price target setup butterflies or condors, and we use that target mapping course looking at that Fibonacci unusual option activity. So we'll go through all this, how we select these trades or how I select them in the course. And then the other one, we do a lot of these because it gives us so much flexibility for a profit zone. Love the butterfly, but this one will widen out that zone if we want it. We can do calls or puts, whatever. So this is long condor, not to be confused with the iron condor. So we'll go through that, how it works, the difference between this and the iron condor, so you know exactly what it is. And then we're going to go through examples, how, when, again, to use the long condor spread. So we can do, it could be a broken wing condor, it could be a ratio condor. I mean, just a lot of different variations, but the fundamental foundation is the long condor. Yes, a question, do you use options around earnings? Yes, so another part of the alert service is I send out selective earnings option trades, okay? So let me back up. I'll just back up 2 seconds here. So the other alerts that are sent out are earnings type trades. And these are going to be option spreads, okay? But they're specifically designed for earnings trades, okay? So they're very selective. So that's the other part that you may receive, selective earning option trades, okay? So one type would be butterfly condors. Mason, that depends on the market, right? Variations of the market. Second could be a calendar or counter diagonal. Could be the third type to be sent out, could be a butterfly pinning trade. The fourth type, which is one we just did, the Russell, could be the breakout reversal trade, or it could be an earnings trade. So 5 different types that may be sent out depending on, the market condition and, what I see. I'm very, very selective with the trades. Just to put it that way. And then we get into that, and then we get into the condor, and then part 3 though is going to be dedicated strictly to hedging. All right, so it's what I call the progression of hedging. We'll go through what that is, and then how we can use these 2 type strategies for hedging. So how to incorporate the butterfly condor to hedge core trade positions, or how to use the butterfly long condor to defend just your vertical debit spread or credit spread that you're using, for defense. Then, a step-by-step checklist of how and when to put these on, kind of a blueprint of that, execution, adjustment, management of the butterfly condor, and then go through, what is assignment risk, expiration, auto exercise, so you know how that works, so you're not freaked out. A lot of people get concerned about exercising, all that stuff, so no worries there. We'll go through that in the course. And then we'll get a really good trading library where you can go back and look at prior, great trades on butterflies and condors. So that will help you, educate you as far as, how to use these trades and strategies. So question, when the holidays are nearly here, do you pause the alerts over the short holiday trading weekend? No, not planning to. If we see a good trade, we'll put it on. And the market's only going to be closed for what, 1 day or day and a half. So we'll put it on. But again, these are select, and you don't have to take them. I mean, they're just trades I send out. So it's not something you have to trade. Obviously, if you want it, it's there, and just take it or don't take it. But I'll be sending out trades, over the holiday period. This was from Richard. He said, this was a really nice feedback. He said, you're the only one that I know that provides competent, realistic instruction on how to have, I love this, Houdini escape hatch plan to utilize when various option trades go against you. So this will be part of the course, the option hedging, right? So Richard says it allows a trader to then calmly use their head to make the appropriate trade adjustments instead of panicking and having their heads handed to them. I greatly appreciate you sharing your hard-earned profitable trading knowledge and techniques. All right, so that's a part of the course. We'll go through how to hedge, and that's really pretty much sums it up, what he said. So let's just go through the bonus package, then I'll take questions, anything you have. So here's a big bonus. Here is my price target mapping course. So in the course, we're going to be actually using this, to set up our trades when I do the course next weekend. But you're going to get as a bonus this total course dedicated just to this, and it's a 3-hour plus, recorded on-demand course, 139-page manual of the course. So this is my step-by-step, kind of way that I use Fibonacci price target mapping, which is a combination of Fibonacci, moving averages, what I call price action, support resistance, standard deviation, price target forecasting, unusual option activity. So this course combines all this to make what I call price target mapping, for mapping your targets for profit or targets for defense. So every trade that we do at Power Cycle Trading, the trade room, whatever, this is one part that I always look at before the trade is ever sent out. I do this mapping on every trade that we look at. And then you're going to get, as just an additional bonus here, start trading options today. So this is kind of a beginner's intermediate course on options, which really will help you. I mean, I would, get this, but do the butterfly course. You're talking 167 for 167. You're getting all this, all these great courses, which are, really good courses. So it's a comprehensive course on the benefits of options versus stocks, things you need to know about options before you start trading, option basics, mastering puts and calls. 3 different strategies are in this course. First one is a covered call strategy is taught, the protected covered call with protected put strategy, and then just the vertical debit spread. So those are covered in this course, and much more there. But those are things you're going to learn in that course. And then you're going to get that additional Christmas bonus. You're going to get 2-month free trial membership to the trading club. So this is where you get access to the virtual trading room that I have open every day, starting at 9:30 a.m. to 10:30 Eastern, Monday through Friday. So, and here you can come in. If you have a trade that you're having trouble with, I can take a look, help you, see what you might be able to do on defending or, adjusting the trade. Or if you have a trade setup that you want to review that you like, we can review that, or you can see what we're doing in the room as far as trade setups that I'm looking at, trade setups that we already have on, adjustments, things like that. And then I do a daily video newsletter every day after the market is closed, to tell you what my view on the market, what we're doing, what I see, what we're looking at potentially the next day. our videos are archived, then we do a weekly live and recorded Q&A every week. You also get a Trader's Educational Vault with good educational material there, plus 60%. If you go to my website, you'll get 60% discount on anything on the site, courses and software. All right, so big bonus there. And this will, let you, buy if you want any of my indicators, if you want other courses, you'll have access. So if you go to my website, powercycletrading.com, and you can see here, once you become a member, you'll receive your members code for your discount code. And then if you want anything, any other courses or software on my site, you can get it. So if you, like, say, go to trading courses here, you can then buy any of these courses with your discount code. Get started trading options today. You're going to get this as a bonus. That's a bonus course. That's, I think that on the website is like $197. So you're going to get that as your bonus. Here's Ultimate Option Guide options course. If you wanted this one, you could come down here, click that. You put in your members code down here. Buy now, $597 if you did that. But if you want this course, you're going to get your 60% off. You just put that into your right here. When you go to pay, you'll see a members promo code. You put that in right there. Or if you want any of my indicators, I've got just all my courses are pretty much designed for directional trading and options. Or if you want any of my software, come here and you can get my scanners and get my indicators. Now, if you want my indicators today, here's everything here. You can custom directional indicators. I'm offering here these indicators, 5-study indicator for $195. If you want those, you should grab them. That's a great deal for you. And anyway, here it's 6% off. I've got just a lot of indicators I've designed, just a lot of stuff. All right, so that's what you get there. Here's one that I always like to comment on. Here was Jay. He said, reading books is fine, but seeing the actual option trade setup makes a huge difference. And so that's the benefit of the trading club. You'll see all this stuff in action. Question, do I do the put call wheel strategy? Some similar, kind of, yeah, we do. You'll see I do a lot of different strategies, but the primary ones are the calendar diagonals, butterflies, etc. And then a bonus for it, we'll do a live follow-up Q&A. Typically we'll do this the day after the course, so we'll do this probably on Tuesday. And then again, you'll have access to the trading room, remember, for the next 60 days. Here's another option course that I've put in here. So this is a 60-page option guide course with videos. This is more focused on the Greeks, how they work, delta, gamma, theta, vega, more on option pricing, what's called the market maker secret, standard deviation, option delta, and probability. So if you're not up to speed on that, this is a great additional tutorial course for you there. So everything really an option bonanza, I call it. And then here's another cool thing. These are my 15 option strategy guide manifesto. So in this one, it goes through and shows you 15 other different types of option strategies that how to construct and use. So things like a back ratio spread, a ladder spread, short straddle, long straddle, strangles. So just a lot of other variations of things that you may be wondering how they're used. And so all that, and then just going through the alert service real quick here, and any other questions. Here's one of my members, Waleed, who actually lives in Kuwait, and he said, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out trade alerts. Some are good, others are not that great. But one thing I would like everybody on the webinar to know is when I get a trade alert from Larry, I do it blindly, as time has shown me. He's dead accurate in his recommendations. Thank you, Waleed. And then here was one just from Dan. He said, very diligent, totally thorough with your analysis. That is the foundation of the success of your alerts. And this is one thing that a lot of members have told me they do. I paid for my subscription with the first 4 trades I took with you when I was just learning how to trade options, okay? So that's another great thing. You'll see with the alerts, they're very detailed, so you can kind of follow along, take the trade, and you're gonna learn as you go. Okay, and I keep the risk on these trades super low, so it's not something you're going to be, betting the ranch on, right? Now, when you get the alert service, here's basically what you're getting. So I'll send out a suggested option trade. But like I said, a lot of members they just want the trades. They don't want to look all day long for the trades. They just want them, and they'll do their own thing. They may just buy the shares. They may buy calls or puts, whatever. But they just want the trades. But when I send it out, I will always give you my suggested option trade that I would do, what the entry level point is, what the profit targets are. These are based on my option, Fibonacci target, what option series we're going to use, stop loss level guidelines, and then I'm constantly updating the trades, with the alert. So if it's, moving up real hard, I'll send out an alert, hey, it's up this much, maybe take some profit. If we need to adjust, for better profit or for defense, I'll send out alert adjustment for that. So these are all sent out to you, and I use what I call the service is called Telegram, which is a really, really good service, and it's free. So you can see here's the IWM trade right here. So we did this was sent out, IWM short trade around 232.70. Make sure to close trade out today prior to the close. Currently up $134 per spread, 148% return. Here is a trade that we just set this one up. We set this one up Friday. Here's the alert sent out. It says new XLI short traded at 137.50, daily cycle high retracement reversal of 21 and broken through the 50 daily moving average. Negative momentum, downside momentum cross. These are my indicators. Gap fill area, target 1, target 2, heavy monthly option open interest. It says buy a diagonal 27 Ds, 20 Ds, 137, 134 at $1.35, things like that. So that's what you get. And then you can see I'll just show you all the different alerts that I sent out, just updates. Here was on XLV. We had a great trade here, XLV, profit, where it is on our profit per spread. So constantly updating, with, whatever you need, so you're not left in the dark. I do a setup video review of any of the alerts that I send out, so you can, see more, why did I do the trade. I have the daily video newsletter sent out. Now you'll get all this for the next 5 months. And then we do a weekly live Q&A, live and recorded. You'll have that next 5 months. Access the virtual trading room, 9:30 to 10:30. Discounts, traders educational vault, all that good stuff. Now here's the counter diagonal kind of summary. We do a lot of these. So we've done, since adding this to the alert service back in June of 19, we've had 312 trades closed out, 226 winners, 17 break even, 69 losers, 78% win rate. Again, these are unaudited, just a summary there. And question, how much variance and price? When I send it out, I'll say, around. So the variance could be 5 to 10 cents. Sometimes you get better, sometimes you get worse, depending on, typically my trade entries are pretty good, so I try to get that timing edge out to you. So when I send it out, you want to try to do them typically as quick as you can, because I'm very, very specific on my entry points. All right. But a lot of times you'll have, plenty of time to set the trade up, so, but it just kind of varies, back and forth. But that's another good reason to come in the trade room, because we talk about a lot of these trades that I'm looking at that may be sent out with the alert service. So it's a good thing with the trade room. We look at that, a lot more detailed there on all these trades. But here's one that we just did last week. This was a really good trade we did on XLV, the healthcare sector. So we did a long put counter diagonal. We set this trade up on the 10th, and it was traded at 144.10. And then we adjusted it the next day and converted this to a put debit spread when it was trading down at 142.70. So we made a nice adjustment and had a really nice return. Now we're still in this trade, but we've had some really good profit take already on the trade. So let's go through. So it's very detailed again. So here's the trade. We set this up. This was the 10th of December. Said new XLV short, trading around 144.10 daily cycle, high retracement reversal off 21 and 200. Now, you know, if you in the trading room, we've been talking about XLV for probably a week. You know, we had this on a watch list, looking at, hey, this might be a potential trade, and then all of a sudden it lines up and everything we wanted to look for the trade happened. So then I sent it out, right? But in the trade room, you would have known about this trade probably, you know, day or two or a week before probably. So then very detailed of how that is sent out. Momentum downside cross, target 1, 143, target 2, 142. By this counter diagonal around 75 bucks is the 144, 143. And then we see we did adjustment real quick here. This turned into a great trade. We did this to a debit spread. So it was traded at 142.70. So I said, if long, the spread adjusted. So I tell you exactly what to do. Buy to close the 13 Ds 143 put, sell to open the 20 Ds 141 put, adjusted trade. Now long the 144 put, short the 144. So we have now put debit spread on. So here you're learning as you go as well. And then I sent out here on the 13th, XLV short trading around 140.20. Look at that. So it went from 144 to 140.59. We were right on direction. If long adjusted spread, make sure to take some profit here, currently up around $143 per spread or 164% return. All right, so I don't leave you hanging. I'm constantly updating. All right, so here's the trade setup. This was just done last week. This was on XLV. So it's trading right here. Our indicators, momentum. So if you want these, you can add them to your cart, 195. Great deal. Cycle reversal, momentum down. Here it was on a 4-hour, everything was breaking down. So it got down here. This was one of our targets. This was our target, 140. So we got down here, take some profit. Now we're still in it. Now if it goes further down, we may adjust this to something else. Or what we'll probably do next, we'll put in a break-even stop. I'll send out, we'll see where it is Monday. So if you have anything left, what we typically would do is put in a break-even stop or some kind of trailing stop. And then I'll send that out by alert too, so you know. But this is what we initially started with. This was a put counter diagonal. So we were long that 144 put, short the 143, 20 Ds, 13 Ds for 70 bucks. And then we did that adjustment the next day. But this was up the next day. This was up $30, $40. You can see right here was up $31 on this spread. So, not a bad return, 30 bucks, 70 bucks risk. But then we did a better adjustment to make it even a bigger potential profit. So we adjusted this to a put debit spread. So now the trade is long the 144 put, short the 141 put at our adjusted cost of $87 per spread right here. And that would give us the potential this next week for a $213 per spread profit or 244% return. But we've already made a great return. Some of the members are already they just take the money and run. And so here's where it was going out, where we were trading it on Friday. So it was up here at 140.62. So it went from 144, now it was down to 140.62. And the spread went from 87 bucks, it was at 230. So we're up $143 per spread, 164% return. And that was on XLV. So that was one we just set up. Here's another one. I'll just go through this one real quick. We do a lot of GLD when it sets up, but this is one that we did on GLD. This was a call calendar diagonal. And you can see here it says new GLD, trading right there, weekly cycle low retracement off the 21. Just very detailed, get in around here and then send out some more alerts, updates. And long story short, this trade ended up taking profit on the 22nd. It was up 200, and it was trading at 250.32. We started the trade here, now it's trading here. The trade was up $362 per spread, 348% return. All right, so these are, this is a quick look here. So we started the trade right there at 242, right here. So again, the indicators that I use, momentum is starting to shift up. I'm using other time frames too. We had what we call cycle reversal. Momentum starting to shift up. Took the trade right in here at 242. right there. That was about correct. And then we did it, I can't remember. We adjusted this trade right here on the 21st. So that was, this was the 19th, we adjusted the trade right here to this call debit spread, and it was traded at 246.48. And then right here, took the profit. It was traded at 250.32. It was up $362 or 348% return on our capital at risk adjusted capital here. So here's where it was trading going out. At that point in time, it was trading at 250.32 right here. And the spread had gone from $1.04 to $4.66. So we're up $362. If you did one spread, 348% return. All right, so that was one that was just set up recently. And then here's just an overview of the butterfly long condors that we do a lot of these as well. So started this back in May of 2019 through Friday. 198 trades closed out, 141 winners, 14 break even, 43 losers, 78% win rate. These have an average, potential loss of no more than about $75 per spread. Very low risk, but potential to make, 25 to 1. As you can see from that example on Tesla, these kind of returns are sometimes possible, Here's the one that we just did. This was that long call condor on Apple. I think I showed you this one earlier, so we'll just kind of flip through this one here. This was a really nice trade. That was one we did just not too long ago. Here was a long put condor that we did on the Russell 2000. This was a short trade, and you can just kind of see the description here. So you get an idea. New short trading around 234.80, cycle high reversal. Targets 1, target 2. So this was buying a vertical put debit spread at 70, and then did an adjustment, adjusted this to a put condor. So showed you how to do that. And then on the 15th, profit it was now trading from 234 to 228. So this was up $120 per spread, or 118. And so here was the short trade set up right there. Here's where we got out right there. Here's where it was trading right when we got out. So this trade went from $34 debit, 34 cents, to 174. The spread blew to. So we're up $140 per spread on that risk of 34, 411% return on that. And then here's just one more I wanted to show you. This was the one that we just did this last week on Thursday and got out yesterday. Okay, so here is the one we just did. This was on the breakout trade. This was one of the first services that I started. This, I think, was the first, but we've done 172 closed out, 125 winners, 6 break even, 41 losers, around 76% win rate. These are very selective. Don't do these as much as we used to, so do more butterfly condors and calendars. But this is one that was set up perfect for Thursday with the Russell shorting the Russell 2000. It says new IWM short trading at 234.65, daily cycle high reversal, breaking below the 21 EMA, daily negative momentum, downside momentum cross, target 1, 233, target 2, 231. We hit both targets Friday. So it says here, by the 13 December 235, 232 put debit spread around $90. And so we did that. And then here was 13th, that was Friday. It says short now it's trading at 232.40. See that? Boom. Target 2, 232, currently up $135 per spread, 150% return. Send out another alert, make sure that you close trade before the end of the day, because this one was expiring on Friday. And so here was the trade setup. This was based on the indicators, based on breaking key support resistance levels. And so momentum indicators are down. It's breaking a key area here of support that we're looking for to set this up. And then we were targeting down to this area here with the next target to 230. So this was just what I call it, kind of a momentum breakdown trade in this situation. So set this trade up here for 90 bucks, debit 235, 232, potential 210. So we didn't get the max profit, but we got pretty close, which is what we want. We weren't, looking basically getting max. These things usually pop down and snap back up. So we got out right when it was trading right about here. So it was trading at 232.40. So right there, this was up, went from 90 cents to 226. So $136, 151% return on that. All right, so just hopefully that gives you an idea of what have to offer here and what you'll be learning next weekend. So if there are any other questions, please let me know.